Hi there, it's Friday the 4th of October 2019. I'm Steve Towers. Welcome to ITB. Let's get started. The OECD paper on the Inclusive Frameworks Digitalisation Project will be published next Wednesday, the 9th of October. It's been reported that the paper will be limited to the Pillar 1 proposals. I'll tell you all about it in next week's ITB. Meanwhile, it looks like Canada might introduce a digital services tax. A DST has been included in the Liberal Party's policies for the federal election, which will be held on the 21st of October. The Liberal Party forms the current government. No details on the DST have been provided. And in regard to the French DST, the chairman of the US House Ways and Means Committee, Richard Neal, is trying to find out the details of any agreement which the US and French governments have made. He sent a letter to Secretary Mnuchin and US Trade Representative Lighthizer seeking this information. I suspect the simple answer is that the details have not yet been agreed. For a copy of Chairman Neal's letter, please go to our website or app. As you've probably heard, there's been a major development in the long-standing trade dispute between the EU and the US in regard to Airbus subsidies. A WTO arbitrator has authorised the US to take countermeasures with respect to the EU and certain member states for approximately $7.5 billion annually. That's the largest arbitration award in WTO history. For a copy of the arbitrator's decision and other WTO documents, and a copy of the US Trade Representative's statement, please go to our website or app. The Platform for Collaboration on Tax, a joint initiative of the IMF, OECD, UN and World Bank, has launched a public consultation on a draft toolkit which aims to help developing countries implement effective transfer pricing documentation requirements. Public comments are requested by the 8th of November. For a copy of the relevant documents, please go to our website or app. And the OECD has scheduled its next Tax Talks Webcast for next Wednesday, the 9th of October at 2 p.m. Paris time. Yes, this is the same day on which the Pillar 1 paper will be released. I'm sure that will be a major agenda item for the webcast. To register for the webcast, please go to our website or app. In Australia, the federal court has decided a case in regard to whether evaporated fuel has been used in a company's business. The case concerns fuel tax credits, which are not available in regard to fuel which is purchased for resale. The taxpayer in the case, Coles Supermarkets, did exactly that. It purchased fuel for resale. However, a small percentage of the purchased fuel was lost due to evaporation. The taxpayer argued that it was entitled to fuel tax credits in regard to that lost fuel because that fuel was not resold by it and it was used in its business. The federal court, however, said no. For a copy of this case, please go to our website or app. In India, the government has decided to declare that for GST purposes, the place of supply of outbound R&D services supplied to the pharmaceutical sector shall generally be the location of the service recipient. For a copy of the draft of the government's notice, please go to our website or app. Also in India, the tax authorities have issued guidance in regard to the interaction between the option to pay corporate income tax at the 22% rate and the utilisation of brought forward tax losses and MAT credits. According to the guidance, a company which exercises the option for the 22% rate will not be entitled to brought forward losses on account of additional depreciation or brought forward MAT credits. However, the guidance points out that there's nothing to stop a company exercising the option after it has utilised those two benefits. For a copy of the guidance, please go to our website or app. In Japan, the new 10% consumption tax rate commenced on the 1st of October. Also, for the first time, a dual rate system was introduced. Certain goods, such as food and non-alcoholic beverages purchased for consumption off-site, will remain subject to an 8% consumption tax rate. Based on its experience with previous rate increases, the government is justifiably concerned about the negative impact on the economy. An early initiative which has been implemented is a government-funded rebate of either 2% or 5% on purchases at participating retailers using credit cards, smartphone apps, and other cashless methods. In Denmark, the tax board has decided a case concerning the PE definition under the Danish domestic tax law, which is very similar to the definition in the OECD model treaty. Here is the relevant structure. A parent company, which is resident in Sweden, has a branch office in Denmark. The parent company has a subsidiary company, Subco, which is also resident in Sweden. Subco has an employee who initially lived in Sweden and worked at Subco's offices in Sweden. However, the employee moved to Denmark for personal reasons. After that move, the employee continued to perform his employment duties for Subco. He did this from two locations in Denmark: his private residence in Denmark and the Danish branch office of the Swedish parent company. An important aspect of the case is that the employee's role was an internal compliance officer for Subco, which was described as a back office role and not part of Subco's core business. The employee had no contact with Subco's customers. The board concluded that the employee's presence in Denmark did not cause Subco to have a PE in Denmark under the Danish domestic tax law. As I said, that definition is very similar to Article 5 of the OECD model treaty. The board considered two specific geographical places: the employee's private residence and the parent company's Danish branch office. In regard to the issue of whether either of those places was a fixed place of business of Subco, corresponding to Article 5.1 of the OECD Model Treaty, the board concluded that yes, the Danish branch office of the parent company was a fixed place of business of Subco. However, the board reached the opposite conclusion in regard to the employee's private residence, because there was the additional factor that Subco had not required the employee, either expressly or by implication, to work from his private residence. But nevertheless, in regard to both places, the board concluded that the employee's activities were auxiliary in character, and thus the preparatory or auxiliary character exception, corresponding to Article 5.4 of the OECD Model Treaty, applied. For a copy of this decision, please go to our website or app. Also in Denmark, a court has held that a VAT refund claim may be made by a taxable person resident in another EU member state, even though that taxable person failed to provide requested information within the 1-month period stipulated in the EU VAT directive. In reaching this view, the court followed a decision of the European Court of Justice in May this year. And speaking of the European Court of Justice, an Advocate General has issued an interesting opinion. Now, as you know, I don't usually cover AG opinions because they're not binding on the court. However, the recent opinion by AG Hogan in the Santander case from Spain is worth mentioning. In that case, the bank is claiming that Spain's goodwill amortization scheme breaches EU state aid rules. Spain's Central Tax Tribunal requested the European Court of Justice for a preliminary ruling in regard to this matter. However, AG Hogan's opinion is that that request is invalid because the Central Tax Tribunal lacks the required independence from the Spanish government to be a court or tribunal within the meaning of Article 267 of the Treaty on the Functioning of the European Union. For a copy of this opinion, please go to our website or app. The European Court of Justice has decided 2 VAT cases. The first case is called CardPoint. It's a referral from Germany. A company provided a range of services to banks in regard to ATMs, including operating and maintaining the ATMs, replenishing them, installing computer hardware and software in them, sending a withdrawal authorization request to the bank which issued the bank card used, and recording withdrawal transactions. The court held that those services do not qualify for the VAT exemption for transactions concerning payments. The second case is called Altic. It's a referral from Latvia. A company purchased food products without complying with EU regulations concerning food safety. The court held that nevertheless, the company is entitled to an input tax credit for the VAT incurred on its purchases, unless the evidence shows that the company knew or ought to have known that the purchase transaction was part of a VAT fraud. For a copy of the CardPoint and Altic cases, please go to our website or app. The EU Council has concluded decisions which authorise 3 member states in regard to VAT. For Romania and Portugal, in regard to the reverse charge mechanism, and for Poland, in regard to restricting the right to deduct input VAT. For a copy of the 3 decisions, please go to our website or app. The incoming EU Tax Commissioner, Paolo Gentiloni, has identified a new way to avoid the EU Council's unanimity rule in taxation. It's Article 116 of the TFEU, which, according to Gentiloni, can be triggered in cases of evidence of an existing distortion of competition in the internal market due to divergent national rules. Here's Article 116. I won't read it out. Please hit the pause button if you'd like to read it. At the most recent meeting of the EU's VAT expert group, draft explanatory notes in regard to the VAT quick fixes were discussed. For a copy of the draft explanatory notes, please go to our website or app. In Finland, the tax authorities have published a statement announcing that the MFN clause in the royalties article in the Finland-Lithuania Treaty was triggered, effective the 1st of January 2019. For a copy of the statement, please go to our website or app. And now to France. In last week's ITB, I briefly mentioned the 2020 budget, which the government has announced. Let me now take a closer look. Here are the corporate income tax rates for the next 3 years. There will be a dual rate structure in both 2020 and 2021. And then in 2022, all companies will pay tax at the rate of 25%. Other notable corporate income tax changes. Firstly, France is implementing the anti-hybrid rules in ATAD 1 and 2. Secondly, as a consequence, the existing anti-hybrid rules in regard to interest expense, which include a subject to tax test, will be repealed. Thirdly, the law will be changed to accommodate the 2018 decision of the European Court of Justice in the Safina case. Accordingly, rules will be introduced to allow for the refund and deferred payment of withholding taxes by foreign entities in a tax loss situation. And finally, the law will be changed to accommodate a 2019 decision of the French Supreme Administrative Court in regard to the branch tax which is imposed on non-resident companies. And some VAT changes worth noting. The implementation of VAT Directive 2017/2455, which addresses VAT obligations for supplies of services and distance sales of goods. The scope of the VAT exemption for UCITS will be amended to align with ECJ case law, and electronic invoices will be mandatory in B2B transactions in 2023. These proposed changes are reflected in the 2020 Finance Bill, which the government has introduced into Parliament. For a copy of the bill, please go to our website or app. In Germany, a bill to implement the EU directive on mandatory disclosure of potentially aggressive cross-border tax planning arrangements, commonly known as DAX 6, has been published by the government. An earlier draft version of the bill was issued in January this year for consultation. There's only one major difference between the draft bill and the current bill. The draft bill's inclusion of certain domestic tax arrangements has been omitted from the current bill. The current bill is closely aligned with the wording in the directive. EU member states are required to transpose the directive into national law by the 31st of December 2019, to be effective from the 1st of July 2020. In Serbia, the government has changed its opinion on the withholding tax treatment of interest rate swaps. Under the new opinion, outbound payments under an interest rate swap are not considered to be interest, and therefore interest withholding tax does not apply to those payments. In Switzerland, the government has decided to bring into effect legislation in regard to bearer shares. The legislation will become effective on the 1st of November 2019. Under that legislation, bearer shares will be permitted only if the company has securities listed on a stock exchange or if the bearer shares are structured through an intermediary. All other companies will have until the 1st of May 2021 to convert any bearer shares to registered shares, failing which the shares will automatically be converted. For a copy of the government's information statement, please go to our website or app. Also in Switzerland, the government has announced 2 proposed changes to the interest withholding tax rules. Firstly, there will be an exemption from Swiss withholding tax on interest payments made by Swiss resident companies to other Swiss resident companies or to foreign investors. Secondly, the existing 35% withholding tax applicable to interest paid to Swiss resident individuals will be retained and will be expanded to apply to all foreign securities held by Swiss resident individuals through an account at a Swiss bank, which is generally the paying agent on such securities. For a copy of the government's statement on these proposed changes, please go to our website or app. In Ukraine, the tax authorities have issued guidance on the VAT treatment of factoring transactions. For a copy of the guidance, please go to our website or app. In Angola, the new 14% VAT finally commenced on the 1st of October, after twice being deferred by the government. The VAT replaces the 10% consumption tax. In Egypt, the government has presented its 2020 budget. The most interesting proposal is that the general corporate income tax rate will be increased from 22.5% to 25.1%, with lower rates for companies with turnover below 10 million Egyptian pounds, which is about $610,000 US. Well, Zambia has finally decided to drop its proposal to replace its VAT with a new sales tax. The introduction date for the VAT had already been postponed 3 times. The change of policy is apparently due to opposition from business groups which did not like the compounding effect of the proposed sales tax. The government's objective in switching to a sales tax was to avoid the compliance and administrative challenges with the VAT. The finance minister was quoted last week as saying that the government will just have to directly address those challenges. There are some interesting developments in Uzbekistan. Firstly, the government has published for consultation a proposed tax code, which includes a number of interesting elements. CFC rules will be introduced, agar will be introduced, and consolidated group taxation will be introduced. For a copy of the proposal, please go to our website or app. And secondly, the government has reduced the standard VAT rate from 20% to 15%, effective the 1st of October 2019. For a copy of the relevant decree, please go to our website or app. In Peru, the tax authorities have published guidance which retrospectively validates the country's GAR provision. Let me explain. The GAR was introduced by legislation on the 19th of July 2012, but its operation was effectively suspended by further legislation enacted in 2014, pending the introduction of regulations. Such regulations were ultimately issued with effect from the 7th of May 2019. According to the tax authorities' guidance, now that the regulations have been issued, the GAR is no longer suspended. And surprisingly, it can be applied by the tax authorities to any facts occurring after the 19th of July 2012. In other words, the period of suspension has now been retrospectively removed, in the opinion of the tax authorities. For a copy of the tax authorities' guidance, please go to our website or app. In the US, the government has released 3 items of guidance in regard to the change to the CFC downward ownership attribution rule caused by the repeal of Section 958B4 by the 2017 US tax reform legislation. The items of guidance are proposed regulations, Revenue Procedure 2019-40 and IRS Release IR-2019-162. For a copy of the 3 items of guidance, please go to our website or app. And now for this week's treaty developments. We've had 2 treaties enter into force and 1 protocol enter into force. I have 2 articles for you this week. The first article is called Recent Developments and Challenges Regarding Exit Taxes in the Context of Tax Treaties, Article 13 of the OECD Model and Change of Residence. It's written by Karen Moser and it's published in the Bulletin for International Taxation. This article focuses on Article 13.5 of the OECD Model Treaty, which, as you know, is the residual paragraph giving exclusive tax rights to the residence country for gains on the alienation of property not mentioned in the earlier paragraphs of Article 13. In particular, the article considers whether Article 13.5 applies to exit taxes, in other words, a tax liability arising because of a deemed disposal of property on the loss of residence status for the taxpayer, plus so-called trailing taxes. And indeed, whether Article 13.5 precludes the application of exit taxes. Here are some of the author's conclusions. With regard to the timing of the application of Article 13.5 in case of a change of residence, it is the resident state at the time when the tax charge arises that has the power to tax capital gains. When the tax charge arises is determined in terms of the domestic tax laws of the former resident state and is usually the date immediately before the day on which the person ceases to be a resident. This situation results in the exclusive allocation of taxing power to impose exit taxes in the strict sense in favour of the former resident state. Such a position also means that Article 13.5 prevents the former resident state from applying trailing taxes. The second article is called The TCJA and the Treaties. It's written by David Rosenblum and Fadi Shaheen, and it's published in Tax Notes International. This article addresses the interaction of US double tax treaties and certain changes made by the 2017 US tax reform legislation, which is commonly called the Tax Cuts and Jobs Act. In particular, the so-called participation exemption for foreign dividends, GILTI, FDII, the transition tax, and the hybrid mismatch provisions. This issue is challenging in light of the fact that under the US Constitution, both the statute and the treaties have equal status. The authors conclude in this way. The theme explored in this article is simple. The need to reconcile or harmonise self-executing treaties, such as tax treaties, and acts of Congress, such as the Internal Revenue Code, given that those 2 sources of law are equal in their constitutional status as the supreme law of the land. A facile later-in-time analysis to resolve conflicts runs counter to US Supreme Court precedent. Moreover, it fails to address the hard questions of what exactly a conflict is and when it calls for a resolution. Well, that's the way it is this Friday, the 4th of October 2019. I'm Steve Towers. Have a great weekend.